Hey everyone, welcome to another segment of Dear Business Owners, where this week I'll be talking about sole proprietorship versus a limited liability company, aka an LLC, right? And we're definitely building off of last week where I talked about business entities as a whole, right? And the question you definitely want to keep in mind as you proceed, right, is am I operating under the right entity? What may be right for your neighbor or your friend or the business down the street is not necessarily right for you. So you want to make sure that you're looking at all of these from your perspective, the shoes you stand up in, right? Not from anywhere else, but from you. Okay. So, with that being said, my name is Rose Brown, also known as the Accountant Therapist, and I am the CEO of Brown's Fulfillment Consulting and Accounting Firm. Of course, I do all things accounting, full service, if you will, to make sure that clients are really okay from a 360 perspective. Okay. So, and as again, Dear Business Owners is all about helping new and already existing business owners better understand how tax and accounting elements impact them, right? Of course, you're not a tax preparer nor are you accounting, but it's also important that you understand certain things from a business perspective through the lens of accounting and tax, right? So this week, it's fitting that we talk about sole prop and LLC. And it's definitely important to note as a disclaimer that this does not stand in the place of legal or professional advice. You definitely want to make sure that you take this as an informational segment and then head on over to your accountant or your attorney to further determine what works best for you. And again, the entity types that we're talking about today is sole proprietorships and LLCs. Okay. And again, I'm throwing that out there. One size doesn't fit all. You may start out as one thing and you may grow into another thing. That's simply how entrepreneurship and business work, right? At least you never want to stay stagnant. You want to kind of grow and keep going upwards, if you will. And sometimes going upward means you need to reassess your business entity. So, with that being said, let's define business entity and what it is. So, a business entity is when one or more person come together in an effort to conduct business, right? And different examples of that could be a sole proprietorship, a LLC, a partnership, an S corporation, a C corporation. So we have several different types that you can kind of choose from. But again, today we're talking about sole props and LLCs. All right. So with sole props and LLCs, it's very important to note that they're almost similar, but what makes them different is huge. It's material. So the first part that I really want to touch on is the difference because it's not a lot of difference, but the differences are major. So a sole proprietor, they're literally just operating as their self themselves. It's just you operating. You have no protection, no nothing. Whereas a LLC, they have a limited liability protection. And that's where LLC comes from, limited liability company. So they are protected unless they do something negligent, right? So with a sole prop, you don't have any liability coverage. An LLC, you have liability coverage. Okay, so that's a major difference there. And even with the LLC, lenders are more likely to lend you funding rather than if you're just a sole prop because it's just you. It's just not enough establishment for them to trust you with all their, well, funding, if you will, right? And then what another difference that come into play is the setup portion of it. When you're a sole prop, it's literally just you. You can start today and stop tomorrow. Who cares? Right? So you don't have to tell IRS that you're starting. You don't have to tell the state you're starting unless you are required to have certain permits or certain local requirements, right? Those are the times that you want to do something from a sole prop perspective. That's why it's a least formal entity, if you will. The LLC, it has a little bit more that goes into it, right? You let the state know that I'm organized as such. And depending on what it is that you plan on doing under your LLC, you definitely want to make sure you get your EIN. Now, when you get the EIN, you're also letting the IRS know that, hey, I'm incorporating as a limited liability company. Okay, so that's important to know. When you're even as an sole prop, it's definitely recommended that you have an EIN. You really don't want to operate under your social security number. You want to keep as separate as much as possible from the business activities. Okay. Now, as it pertains to similarities, right? We're going to start here. A sole prop and an LLC, and I'm going to say a single member LLC and a sole proprietor. So it's one. Only one person is operating these particular entity. That's the major similarity as we start. Now, the next thing to note is that they are disregarded entities. When a company or a business is a disregarded entity, that means it's usually one person operating it and they're not classified as a corporation. So what that then leads into the fact that the business now becomes a flow-through entity. And a flow-through entity pretty much means the end result, the end activities of the business trickles down into your personal return, and you, the owner, the sole owner, is ultimately responsible for paying all those taxes, right? Anything that's assessed to you, or even if it's a loss, you get to use that loss to write off against any other income that you may have, depending on the situation. Okay, but ultimately a flow-through entity means everything flows through to your personal, and you are ultimately responsible for everything having to do with those business taxes, or really they become personal income taxes when you go to file your personal return. Okay, so what that means is, usually if it's a flow-through entity, the business itself is not responsible for its own taxes. So it then means that it's a personal income tax, which means if a tax is actually due to, say, the IRS or the state, and you're a flow-through entity, you don't want to use the business bank account to pay for those. You yourself, your personal account pays for those because it's a personal income tax. Now, on a local level, or depending on the state, if you incur a tax because you have a business, then you can go ahead and use a business bank account and make those payments. But if it's to the IRS or to the state, generally those are personal income taxes. So you want to make sure that you're aware. The only entity that's truly responsible for its own taxes is a C corporation, right? Which we'll be talking about next week or the week after, who knows. But ultimately, flow-through entities, you are responsible for everything, okay? Now, from a tax filing perspective, and something that I do want to share with you guys, let me actually just go ahead and pull it up. Okay, I'm sure you guys can see my screen here. So I want to talk to you guys now from the tax filing perspective. And this goes to show how similar a sole proprietorship is to an LLC, right? Honestly, everything from a tax perspective is a reflection of each other. So if you look here from the left side of the screen where it says owner type, right? So we broke it down per the owner type. And as you move to the right, well, how do you pay yourself? Well, whether you're a sole prop or a single member LLC, the way you pay yourself is by taking owner's draw. Now, that looks different for a lot of people, depending on how much you're able to afford to pay themselves. But ultimately, you want to keep it in a consistent manner, right? So if you're going to do, I'm going to pay myself $1,000 a week or $2,000 every other week, you want to just kind of keep it consistent as you move forward. But know that as a sole proprietor or a single member LLC, you are not an employee. Therefore, you cannot go on payroll. And I'm just going to say it again because a lot of people misunderstand how this works. They want to be paid on payroll, not knowing that they have to do something extra in order to go to that level. So if you are a sole proprietor or a single member LLC, you cannot go on payroll. You are not considered an employee of the company. You pay yourself by taking owner's draw, and that looks different for a lot of different people. Okay, so that's important to know. The only way you can actually go on payroll, actually as a single member LLC, is if you elect to be taxed as an S Corp or a C Corp. Now, as a sole prop, you cannot elect S or C Corp status. You actually have to start either as a single member LLC or a C corporation and then elect S Corp status. So it looks a little bit different, but ultimately, that's the only way a single member LLC can pay its member on payroll, right? Electing a status, whereas a sole proprietor cannot do that unless they actually become an organized entity at the state level and then letting the IRS know, hey, we are going to elect a different type of tax entity. Okay, so that's very important that you understand. So the tax reporting form, that column, third column over, you'll see that it says Form 1040 Schedule C. Schedule C is where your business activities are reported from your activities as a sole proprietor or a single member LLC. That's where your activities are reported. Now, a Schedule C cannot be filed by itself. It's important to know. I've seen this happen plenty of times in the past where folks ask, hey, can you just file a Schedule C? No, I cannot. It's the entire return, right? So the Schedule C reports the business activities, but it ultimately gets reflected on your personal tax return. Right. So on your Form 1040, you'll see on there where it says business income, something of that sort, but ultimately it flows through to your personal tax return. And that's how it really becomes a personal income tax. Okay. Keep that in mind. The next major part here is the self-employment taxes. And this is a hard concept for a lot of people to understand. So I'm definitely going to do an overview of this just now, but make sure to connect with us or your accountant to further understand the true impact in your particular situation. So self-employment taxes are made up of Social Security and Medicare taxes, right? And in that situation, it's usually 15.3% of your net profit. Now, 15.3% is a makeup of both the employer and the employee portion of the taxes, right? So the employer has to pay half, the employee has to pay half. The good thing is, as a sole prop or single member LLC, you get to deduct 50% of that self-employment tax. Now, that 50% is just the employer portion, right? So you have to pay the tax, but then you get a deduction for it. Now, these taxes tend to add up very quickly. So you want to make sure that you're assessing whether or not you're operating from the right entity periodically, because you don't want to wait until the end of the year and you can't really retroactively fix certain issues, right? So you want to make sure that you're periodically assessing whether or not you should continue to operate as a sole prop or a single member LLC in an effort to mitigate your tax liabilities. Oftentimes, your tax liabilities stem from your entity. Okay, so you want to make sure that you make that note there. But the good news about the sole prop and the single member LLC is that there are no double taxation. You're literally just paying your ordinary income taxes and your self-employment taxes. Now, let it be note, every person who earns income in the United States have to pay self-employment taxes, right? Whether it's through when you file your personal tax return because you have a Schedule C, or you're an employee. And I know a lot of us, if we look at our paychecks, we'll see, Social Security and Medicare, that's being taken out, but we're only seeing our portion, right? So a lot of people get confused, and it just, especially when it becomes taxes owed, we just don't really want to understand, because nobody really wants to owe taxes, right? So just make sure that you understand that you do have that obligation, both self-employment taxes and ordinary income taxes. Okay. And a lot of folks oftentimes ask me, especially the fact that we're talking about taxes now, is, well, how can I account for taxes being that no one's taking it out for me? So in situations like this, and really as a self-employed individual, you're ultimately responsible for all things taxes, right? So what that means is you need to be disciplined enough to set aside a portion of what you earn towards taxes. And of course, if you anticipate that you will owe, you will need to make estimated quarterly payments. Okay. And the rule of thumb, and this is general, it's a give or take kind of scenario, but the rule of thumb is 70% comes home with you and 30% gets paid into taxes. Now that 70 to 30% is based on the net profit, not the gross. So the gross is the overall, the net is after your expenses. So you want to keep that in mind. Okay, so 30% generally accounts for your federal taxes, your state, and your local. Depending on where you are, you may not even have local taxes, right? So 30% may not be where you want to, how much you want to take out. But ultimately, on average, 30% usually covers your tax liability. Now, that's a average. So depending on how much your net profit is, hey, you're doing great, no problem. You may pay a little bit more in taxes. If you don't have a high enough net profit, you may not be paying as much. Or if you have a loss from one business and a profit from another business, it comes down, right? So you want to kind of keep that in mind here. Okay. Now, for a lot of folks, it's, well, what are the pros? What are the cons? Listen, the pros and the cons will look different from your situation, right? If you literally just want to operate today and not operate tomorrow, uh, sole prop, sure, you don't have to do any type of formality, but of course, you risk yourself being exposed to unlimited amount of liability. And in today's society, you do not want to leave yourself so open to where anyone can take a jab really at your asset, at your personal life, right? Your bank account, your house, those sorts of things. That's why people get LLCs, because they get that liability coverage. That's very important. Even though you might spend a couple hundred registering, depending on who you go through, it's worth it rather than not paying that couple hundred and having to pay a couple thousands, even millions if you're ever sued. So you definitely want to weigh those pros and cons. Are you willing to expose yourself, or hey, you know what? I'm gonna pay that couple hundred so that I can protect myself. So you want to keep those things in mind. Okay. Um, with that being said, really, that's it for this week. I've touched on sole props versus LLCs. Generally, they're the same from a tax perspective, but from a legal perspective, they're absolutely not the same, because the LLC give you that liability coverage. The sole prop, you're literally open wide for anything that could come your way. But from a tax perspective, as you can see here on the screen, you literally pay yourself the same, you report taxes the same, and you're ultimately paying the same type of taxes. Okay. With that being said, next week I'll be talking more about S corps versus C corp. So you definitely want to tune in there. And of course, if you have any questions, definitely comment. Let me know what's going on. But that's pretty much it for this week. Don't forget to like, subscribe, share. I know this information can be very useful to a lot of people, and it's why I'm doing it every week, to make sure that I'm reaching folks who may not be able to afford to say sit down with a professional, but just to kind of get the ball rolling, and just to increase that education level from a business perspective, looking through the lens of an accountant. Okay, that's very important. So I will see you all next week for another delicious topic. Okay.